participants, welcome to the Corporate Finance Day. Welcome to this keynote speech on the joint future of private market and impact investing. So welcome also to HEC Liège, which will be your virtual host today. HEC Liège, this is the management school of the University of Liège. It's a leading business school in Belgium, which offers both graduate and postgraduate programs. It holds also a double accreditation, EQUIS and ACSB. It has more than 3,000 students and about 105 faculty members. The international vision of the school is integrated into its research program in management and economics, but also in the development of its teaching activities in Asia and its worldwide partnership with companies and universities. Being the Vice Dean for Research, I can testify of the quality of the work conducted by our researchers. We are active in 7 strategic fields, and one of them is asset and risk management, in which we develop research in finance, but with an impact on sustainability, digital transformation, and entrepreneurship. I'm sorry you could not visit us today because we are located at the heart of Europe, but I hope that this small video played during the waiting time gives you a small taste about Belgium. So today was the Corporate Finance Day. We had more than 34 paper presentations running in 11 parallel sessions. For the first time in 17 editions, it went virtual. We had more than 100 attendees during the day, coming from Europe, but also from China, Asia, Hong Kong, and also United States and Canada. So I think we can really affirm the international reach of the conference. And I would like to thank our sponsors, so private companies, Closing, Refinitiv, and Capital at Work, as well as the National Research Fund for their support. Important topics were discussed today. So the corporate finance theory is grounded into the work of Modigliani and Miller on capital structure, but also on agency theory from Johnson and McLean. A large part of the literature focuses on large firms, but corporate finance has been extended to small and private firms, private equity, venture capital, banking institutions. All these topics were discussed today. And corporate social responsibility has also been integrated into corporate finance, and the impact of this on stakeholders is also worth to study. So it's my pleasure to wrap up this exciting day with an exciting keynote on the joint future of impact investing and private market, or if you want to rename it as the keynote speaker did, Will Finance Save the World? But let me introduce you our speaker. So Ludovic Phalippou is Professor of Financial Economics at Saïd Business School, Oxford University. He is the head of the Economic Accounting and Finance Group. He specialized in private equity and asset management. He got his master's degree in economics from Toulouse School of Economics, but also a master in mathematical finance from Southern California. He graduated from his PhD from INSEAD and started his career in Amsterdam before moving to Oxford. But let me introduce him a little bit more. Ludovic is someone who can get more than 1,000 downloads for one single paper posted on SSRN in one night. He's certainly one of the most outstanding researchers in the field of private equity and one of the most influential individuals in the field in Europe. His work has been published in top journals such as Journal of Finance, Journal of Financial Economics, and Review of Financial Studies. He's someone also who could make Zoom to crash because more than 1,000 attendees would like to connect to his professional webinar. He has developed very strong links with the industry and appears regularly in the financial press, such as New York Times, Financial Times. But there is another side of Ludo. He's a catchy writer. His best-selling book, Private Equity Led Bear, depicts the funny story of Alice discovering the private equity world. He's also a wine lover, especially the full-bodied wine like Terrasse de Larzac. And if I'm not mistaken, he was the vice president of the wine cellar at Queen's College at Oxford University. And he has worked hard this year on the preparation of a master in wine discovery. He's also someone who doesn't hesitate to come to Belgium to cycle 280 kilometers under the hailstorm. Also, is someone for whom you need to subscribe to an insurance when you invite him as a keynote speaker. His outspokenness and provocative talk always animates a large debate on the social network, and I hope that we have some representative of the private equity industry and the private industry here today with us. Last but not least, Ludo is a friend, so I would like to thank you, Ludo, for coming virtually to Liège, and I'm really looking forward to hearing to your talk. Before giving you the floor, let me remind the session rule for the attendees. So all your micro has been muted in order to ensure a good audio connection. You can send us your question using the chat, sending them to all participants so that we can moderate the Q&A at the end. So now, Ludo, will finance save the world?
Thank you very much, Maria. I'm afraid after such a great introduction, I can only disappoint. But let me tell you what I'm going to talk to you about today. I believe at one point I'll be able to share my screen. Okay, thank you. So I'm going to present to you something a bit unusual. It's not really like a research paper with results. It's more like some thoughts. So it's a bit of a dangerous presentation. It's about some thoughts about a big topic, something getting really big, and I have a few things I'd like to share with you. And again, it's not like the results of a research. It's more like to provoke some thoughts and engage in a conversation. So I changed the title of this presentation to make it broader and to call it Will Finance Save the World? So basically, I think the starting point is that there is no planet B, and we kind of probably screwed up a bit planet A. And I think the initial thought was that science will save us. Science will document facts, and science will find solutions. And I didn't keep this quote that I came across one day by a scientist, but it was very telling. Someone said, I spent all my life as a scientist, and I thought that if I were showing the facts well enough, if I prove causality between greenhouse house emissions and warming up of the planet, etc., then I would solve the problem. And he came to a realization that showing scientific evidence is not enough. It's actually doing very little. The people driving the train, what drives the world, to his recognition was that it was not science, but it was economics. It's economics incentives, it's economic decisions that are driving the decisions and create the bottleneck whenever there is one. And the problem we have is that decision makers are not incentivized to fully account for externalities. That we know since the very beginning of economics, externalities is a big problem. Decision makers don't take them into account, and it creates all kinds of problems for society. The environment is a clear one. A firm may make more money and pollute a river. They don't pay the cost for that, so they will overpollute and so on and so forth. The initial thought, and we still find that in most economists' mind, is that that's exactly why a government and regulators exist. These guys need to create some Pigouvian tax, for example, for negative externalities. They need to create law regulations in order to prevent people from polluting or to penalize them when they do, etc. And what is a bit new in the economist mindset is the realization that it's actually not going to work. And maybe some people realized that a long time ago, but I think there is now a growing consensus that governments are not able to do that. Governments compete with one another, countries compete with one another. So if India wanted to be like super tough in terms of environmental regulation, then companies move to Pakistan. Okay, and so governments cannot really do these things because they compete with one another. They also often captured, lobbied, etc. And so they cannot do that. They cannot do what economics textbooks say they should do. And so the bottom line is that we, the economists, are the forefront of the solution and the problem. So this is big deal, and this field is getting into economics, and I think we'll keep growing there, and this is where the solutions will be found if we find any. Okay, so far the business folks of course understood that they will be part of a solution, and they have created many initiatives. I've put the main ones here. There are much more in case you worry. We call that sometimes the alphabet soup. It's lots and lots of initiatives, and so far, you know, I can see how it generated a lot of PR, public relations, disclosures and exercises. I don't know if we have much evidence of causal change of any of this into people's behavior. We have bits and pieces, but it doesn't look like there is like significant causal change triggered by these initiatives, really, as far as I can tell, but you know, I might have missed it. Now, the thing is that when you read all of that, and I've tried to read like most of what people that are behind these initiatives write, I've tried to summarize it and to put it in a nutshell, I guess in the tradition of economics, trying to see like what is it saying at the end of the day. And most of what I've read like something like this. You need to do good in order to do well. So you need to follow certain principles, or you need to invest in certain type of industries to make sure that you combat poverty, or I don't know what, the entire list, and then you will do well. Because you did good, you will do well. There are other names like, you know, if you do good, you grow the pie. If who cares, win. And so that's this idea always that there is no trade-off. It's all like you need to do good and then you'll do well. And that for an economist sounds like pretty amazing. Like something without a trade-off is actually sounding amazing. And if you try to think about what is the underlying assumption here, and it sounds like something like this, okay? The corporations are not maximizing the value of companies, because if they do more good, they will do even better. So they are not maximizing profits. And the markets are very inefficient. Like the markets people are making systematic mistakes, and there is no arbitrage, right? For a market to be inefficient, you need to have both the mistakes that are systematic, people not learning, and there is no arbitrage mechanism to penalize the companies that do not see how to increase profits by doing good. And so then you have this like highly inefficient market that just stays stuck. And so the financial markets are blind, they don't see it. The corporate leaders are blind, they don't see it. But then there is another category of people out there that see what to do, like to do all this good, and they just need to enlighten these financial market participants and these corporate leaders, right? Because all these guys are blind, they don't see it because they leave money on the table, right? It's if you need to do more good to do more well, then you're leaving money on the table. And so these people are not seeing it, and all these initiatives are there to open people's eyes to it. And so in another way to put it is that these negative externalities that all these people generate by like mistreating their employees or not paying attention to the environment will come and bite them and will hurt the profits of companies, and they just don't realize that. So these are all like imperfect people in need of a good light, and they don't see it. But there are some folks out there that do see it, and they will educate them, you know, require disclosure and accounting metrics, etc., so that they open their eyes. That's a lot of assumptions. Okay, that's a lot of assumptions. I'm not saying it's not possible, but it's a lot of assumptions, and I think it's important to recognize that there are lots of assumptions here. Okay. And I don't know if I've seen much causal empirical evidence that there are all these blind people, and then if you enlighten them, then they suddenly realize that they were leaving money on the table, and they change their ways, and then the companies are becoming more profitable. Again, it's possible, but it's. But in any case, it's like, you know, why would anyone reject this win-win? Okay, like it's a fantastic world here. Okay, like you do more good and then you will make even more money. So like, you know, it's all cool, right? So I had prepared a bit of a music to celebrate this win-win. I won't play it too long in case I owe money to Walt Disney, but I had this small. I let you listen to it a bit later. It sticks to your mind pretty well, but it's in French as well. So the people who are actually the idiots in this story is like quite a few of us on this call, I guess, is financial economists. They tend to be the people who have an issue with what I just said, okay? And so what's their problem? Why do they have a problem with this win-win? Okay, what's wrong with that? So the financial economists have basically found two things, okay? There are two big results in financial economics. One is management usually does not maximize company value, okay? So there's this huge literature showing that management is already not maximizing corporate company value. They prefer, you know, to travel in private jets, to have splashy headquarters, do all these sorts of things. And then now we are telling them that, look, you could be like Mr. Save the Planet with someone else's money, okay? And most financial economists see this as yet another perk. They see this as a chance of going with your private jet to Davos and to go to Davos to like give this big speech about saving the world and being Mr. or Miss Nice Guy, okay? And so we are nervous because we knew that already management and executives tended to do that without this green thing. And now they have another like carte blanche saying, oh, please, you know, don't worry about this profit thing and just do nice things, do you know, and you'll be great. Okay, so we feel that there is like a loosening up of corporate governance that makes us nervous. That's on the corporate finance side. On the asset pricing side, the big literature shows that professional money managers are not really deserving their salaries, to put it bluntly, okay? And so they typically have pretty bad returns on aggregate. They don't deliver much on aggregate. They get paid extremely well. They don't deliver much. And the literature has shown all kinds of ways that people do to hide this fact. Okay, so they window dress track records, etc. And now we see this trend as a golden excuse for fund managers to say, oh, please forget about looking at returns. That's not what matters. Forget about looking at my pay, my compensation, etc. I'm doing good, okay? And that's all what matters. So leave me alone, let me be. Doesn't matter what my returns are, what my pay is, I'm doing good. And in fact, to take a very concrete example that happened a few weeks ago, when I released the study on the performance of private equity over the last 20 years, and that was basically showing that the performance was mild, just about equal to public equity. And however, that the compensation to a few individuals were in the billions of dollars, okay? You had a number of people that would say, oh, this is all wrong, but they didn't bring any evidence that it was wrong or what the right figures were. And you had a group of people, and some of them, I think, ordered an op-ed in the Wall Street Journal the week after the Financial Times covered my work. And the op-ed by some academics in the Wall Street Journal was all about, look how much good private equity does. Look how much good it is doing to companies and to the American society. And that's exactly what I'm talking about, is that as soon as you say, you know, what matters is how good we do to companies, how much jobs we create, you give these sorts of angle, then people say, okay, forget about like, don't look at how much I'm paid, don't look at my returns, doesn't matter, I'm doing good to a society, so just leave me alone. And I think that's why a number of financial economists are quite nervous actually with a win-win, and so are not that relaxed about what seems to be like all fantastic. Okay. And then there are some, I advise you to watch this debate. It's very interesting. I'm going to take a few things from it. At one point, for example, Colleen, my colleague, says, companies should maximize employee well-being because satisfied employees cause superior financial performance. And when I hear this, I freeze. I don't understand. I don't understand what that means. And that's it's a pretty standard sentence you would hear from the proponents of all these initiatives I just mentioned. My reaction is, what if I double the salaries in any company? Surely people will be more satisfied. Do I increase profits? It feels quite counterintuitive. Like if all of us have a salary double tomorrow, I'm not sure all of us will have our company's profits going up. It sounds weird. So this cannot hold. Like, why are they saying things like that? Another thing that then comes up, and that's very often the case, I have several colleagues doing this, saying these things, writing books about this. All of the successful companies have a purpose. They know why they do what they do. Take Apple, take Google, take Microsoft. They all have a purpose, and that's why they're successful. So you need to have a purpose to be successful. Many unsuccessful companies have a purpose. About any company has a purpose. A drug dealer has a pretty clear purpose. I'm not sure all companies are successful. I'm not sure having a purpose is necessarily a good thing. I don't see the link again. And so there are a number of these things that it sounds weird to economists as stories. Like I and many other people just don't get it. Okay. We do understand why some consultants love it because that creates lots of jobs for them. But we have difficulties to understand what's going on. And then you have this quote like in the Financial Times that summarized pretty well like how we feel, but it like there is shaky assumptions. We don't really always understand the statements like the ones I've shown you. And so we don't know if it's really like cosmetic or real, and it's uncomfortable. Like we don't know what's going on. Okay. And it's raining cash. Okay, so there's tons of money going to asset managers, green bonds, etc. that goes for this win-win. Okay, and why not? I mean, like if you tell people, look, you will earn just as much, and you can do good, or even you will earn more by doing good than if you just do the usual things. Why not? So all this money is like going there, and they don't mind paying higher fees. They don't mind, if the returns are, they are looking for higher returns. So there is certainly money flowing in, okay? And so there is this very happy cow climbing up. That's like the issuance of green bonds on the y-axis. Okay, so I'm going to try to bring up like some core finance concepts that most of you are very familiar with, but just to insist, I think that it's important to remember that if you want to change things, you have two dimensions that are quite important. One is whether you have control of your assets, and one is whether you are acting on the primary or on the secondary market. So if you're acting on the secondary market, for example, you go to the stock market, if you sell the shares of Philip Morris and buy the shares of BlaBlaCar, which is a very nice car pooling French company, you are not changing anything to the company. You are getting the shares of BlaBlaCar from someone else, and you are selling the shares of Philip Morris to someone else. So it's important to remember in the secondary market, you're just changing who owns the shares, but you haven't given money to the company. You haven't invested in BlaBlaCar. You haven't invested in Philip Morris. And very often people mix that. They don't quite realize that. And control, if you are buying stocks of a company that, for example, is publicly listed, you have a small share of that company, and you don't have control. You will not change the company with your few shares. If you have control of a company, you can change things because you control it. So if you look at what is a magic corner in a sense of where you can really change things, it's things like venture capital, growth equity, real assets, development. This is where you have both control and you're on the primary market. The rest, including leveraged buyouts, is a secondary market transaction on which you have control, so you could change some stuff, but it's a secondary market transaction. The company is changing hands. The money invested in an LBO doesn't go into the company directly. So I think it's important to have these sorts of concepts to like clean up a bit the debate and show to people a bit what is it they really get when they are given like an ESG mutual fund or things like that. So an ESG mutual fund is really something here in the Southwest part where you won't change much things by having more shares of one type of company versus another. So then, should we allow people to market themselves as doing good if all they are doing is selling feel-bad stocks to someone else and buying feel-good stocks from someone else? Okay. Should we write this on the tin? Should we make it clear that this is all what's happening here when you buy an ESG mutual fund? That you have just given money to one guy who already owned the shares and received money from someone else. Like you didn't give money to the company. So investing is not really, you're not investing in that company. So maybe these sorts of things could help a bit. And not as well the contradiction. Either you do not impact the company by selling their shares or buying their shares, or you do. If you do not impact the company, you do not hurt your returns, but you haven't made any changes. If you impact the cost of capital of the company, which is often an argument, by buying more of like the feel-good stocks, then that means by construction that your expected returns are lower. If you have impacted the cost of capital of a company, you have increased the price, you have lowered the cost of capital of a company, you have decreased the expected returns. And yet what these funds are telling you is that you will get higher returns because you may impact the cost of capital, which is a pure contradiction. What they have in mind probably is a few more assumptions you need for that, is that you have detected the right companies before everyone else. So again, like a big inefficient market story. And then once everybody wakes up to it, suddenly at one point in time, then you become richer. But at this stage, that's it, it's in the price. So you will not get any extra return from that point on. And this gets lost over time. Like this never really show up in the debate, in the communications. So it's very weird. A concrete example recently is that highly rated ESG companies did well during the COVID. Immediately people said, including Al Gore, oh, that proves that high ESG companies are resilient to crisis, that's the future, blah, blah, blah. The reason why they did well, these companies, is because they were mainly tech companies, and these companies have good ratings of ESG, and the companies that did badly were airlines, oil companies, because there was no more demand for oil. And that's why they did badly. And these companies tend to have low ESG ratings. So it has nothing to do with them ESG rating, ESG rating companies doing better or being more resilient. And it's just an industry effect. And I would insist on that. That's a fairly dangerous route to like take this sort of event and say, oh, that proves my point. Okay. An important notion is the notion of additionality that I've already touched a bit upon. If you want to make a change, your money needs to be additional. What additionality means is that you're making the change you're making wouldn't have happened without your money. If there is additionality, it means you have concessionary returns. You are accepting lower returns. Because if you didn't have to accept lower returns, it means we didn't need your money to make the change, because the change would have happened anyway. If you have a project of creating a company that will solve pollution and it will earn a normal rate of return, there is no need of impact or green money to finance it, because there will be enough of normal money to go to that project. Only if like nobody wants to finance this project at the current conditions, then you can bring in green money that will then accept a lower return in order to finance this good project. But by construction, something can be additional only if there is concessionary returns. I don't see how it is possible that you would have both a normal rate of return and an additionality aspect of your project. It's almost impossible. I didn't see how it's possible. Okay. So here are two examples of things that are given as usually counterexample. So this is actually a true company that won a prize for like the best ESG of the year. So there was a paint company run by a private equity firm, okay? And the private equity firm won this award, wrote a long case study about how, you know, they bought this company and they switched the paint from being bad for the environment to a good environmental friendly paint. And they increased the profits of the companies because people love the environmental friendly paint. Okay, so people like me would buy the environmental friendly paint, even as a huge premium. And so this company made tons of money. So people would say, this is an example that you are doing something good and this is how you did well. Okay. The issue is, this is not additionality. Because if you made more money by making the paint cleaner, even if you didn't care about the environment, you would have done it because you want to make more money. So there is no additionality. The impact would have occurred with or without your green money. It's if you make more money by making the paint more environmental friendly, the normal markets would have done it. Somebody who didn't care about ESG would have done it. So there is no additionality. Okay, and if there is no additionality, are you having impact? Well, go back to the definition of additionality. If you're not doing something additional, things would have occurred anyway. You're not having an impact. You're not changing anything. Green bonds, same things. There is a huge increase in green bonds. What most of this looks like is that they are promised like normal rates of return. If so, that means they are normal bonds. And what we see governments now doing is that instead of just raising money for like government spendings, what they do is that they say, well, there is this subset of government spending, which is kind of like green projects. And we're going to raise green bonds for these subsets of projects, and then pink bonds for another subset of projects, and so on and so forth. And if you don't have concessionary returns, then there's no additionality. This money would have gone anyway. If there are concessionary returns, then now we are talking business. Now you're raising more money than you would have had otherwise. You're doing some projects you wouldn't have done otherwise, so on and so forth. And there is massive resistance to this idea that there is impact only if there is additionality. There is additionality, there is only, you can only have concessionary returns, because that violates the win-win rhetoric. Now, I won't play you the blah blah song, although I advise it's a very good one. But just to say that no one denies that it is great and that there is some truth to companies sometimes don't see that by being more environmental friendly, they may make more money. But it's not like an automatic rule. Is that in some cases they might have missed it. It's possible. But that also means that in some cases maybe they treat their employees too well. By treating them worse, then they would make more money. It's kind of like business as usual. Is that sometimes companies may not see a way to improve their profits. But that's important to keep that aside. That's business as usual. This shouldn't get a label like ESG, green, etc., that would attract some money, but thinks they are making a change. The money that is going into ESG funds and the like think and they are marketed as they will make a change, a positive change. They will have additionality. And yet, not only they will not have concessionary returns, but they would have even better returns. That's very, very hard to accept that this could be true. Okay. Now, again, we don't mix things. You can have a company that makes paint and they hadn't realized that by making clean paint, they could have made more money. They need consultants for that to open their eyes, maybe, okay? But that's business as usual. That's not special, okay? Now, continuing on that theme, I want to tell you a story to illustrate what I think is a big trap and why this is a big deal. What we've been just talking about, why the win-win route and pushing the win-win route is a tricky route. Once upon a time, there was a college in Oxford that was girls only. And only girls could go to the college, and boys were not allowed to visit, except boys were visiting the college. And there were a subset of women at the college, of the fellows, that means the professor that lived in the college. And there was a subset of women who had a big issue with boys coming to visit girls and staying overnight in that girls' college. And the issue was was a moral issue. It was what we call a categorical imperative. They thought it was wrong for boys to stay with girls overnight in a girls' college. But they felt bad about saying that they had a moral issue with that. So instead they said, you know, the college cannot afford boys staying overnight. And so the other fellow women said, why is that? Why is it more costly? What's the extra cost? And so then these women said, well, you know, they may use more water, they may, you know, we may need to clean sheets more often, etc. And then the response of the other fellows were, well, let's calculate the cost, the extra cost of boys staying overnight in the college. And they calculated that it was 50 pence per night. And so it was decided then that if the college would charge 50 pence a night, then boys could stay overnight. The front page of the Guardian the next day was, sentence girl, 50 pence a night. So clearly that was not what these women had in mind. And it was even worse than they had in mind. Charging 50 pence a night to stay overnight with girls at their college. Okay. And why did they end up in this situation? Is because they had a categorical imperative, they had a moral issue. And instead of saying they had a moral issue, they went for an instrumental logic by saying, we cannot afford it, and therefore we cannot have it. And that went wrong. And here we have the same thing. We have most of these ESG-friendly people are very nice people. And when I talk to them, I read them, I think that what they are saying is they have a categorical imperative. They are worried about the planet. They want to save the planet. They want to do good for the sake of doing good. It's a moral issue they have. But because they don't want to bring the moral issue on the table, just like the fellows of St. Anne's College, they are bringing an instrumental logic. They say, oh, the world needs to do more environmental things. They need to treat employees better, etc. But please don't worry. I'm going to come up with evidence to show you that if you do that, you will do well financially. So it's all good. That's very dangerous, just like the St. Anne's College. It's dangerous because, and I understand why they may do that, because the law is maybe against you if you don't do that. But imagine that you have like one day like a wave of hurricanes coming up because of global warming, and that actually ESG stocks, high ESG stocks, do less well in that case. Then what are you going to do? You're going to say, oh, forget about ESG, forget about doing better, building a better world because high ESG stocks went down when the hurricanes were here, so forget about it. That's a problem with instrumental logic, is that if this instrumental logic is not working at one point in time, it backfires, and then you're in a difficult situation. You had used like the COVID crisis saying, oh, look, high ESG stocks do well, therefore high ESG is good. This is what will save humanity. If there is another crisis and it's the other way around, it's going to backfire. And you don't need to be in that situation. If you would have voiced your categorical imperative, if you would have framed it as such, if you would have said, we need to treat employees well, we need to have living wages for everyone, because that's the right thing to do. We do not care if it's increased profits or not. Women on boards, on companies, be feeling safe at work is not a matter of proving that if you have more women, you will do better financially. It's a categorical imperative. It just needs to be. It's a moral issue. There is no debate to have whether it increases profits or not. Forget about it. So this instrumental logic is very dangerous. It gets you, it can backfire very big time. And the fact that you have a group of academics who, whenever they write an ESG paper, always find that if you do better environmental practices, better treatment of employees, you always increase profits, doesn't sound really like good research. In good research, you may find sometimes things going one way, something going another way. This sounds more like evangelical people. It sounds like you have a categorical imperative that you're trying to force feed. just write it if you have a categorical imperative. Say, my categorical imperative is the following. Rather than trying to find ways to justify your, in an instrumental way, what you want the world to go to. So something else that happened in the debate after that is that Colin asked a very good question to Lucian. He said, what if there was a company that could build ventilators during this COVID crisis and they would lose money if they do that? And Lucian was embarrassed with that question. He was like, well, that wouldn't happen because if they didn't do that, then, the company, would be suffering because people would boycott the company. They would be angry at the company. And so it wouldn't be profit making. And so that wouldn't be the right thing to do. So the company will build the ventilators. And Colin said, no, it's not a win-win. They will really lose money, like now forever. That's it. They will never recoup it. It's a money-losing project to build ventilators to save lives. Do they or do they not do it? That was the right question, because that was bringing it to the categorical imperative ground. It's like, are you using an instrumental logic or are you using a categorical imperative? If you are doing instrumental logic, here you are saying to this company, don't bother with ventilators. If you are using a categorical imperative, you're saying, yes, you need to build it. You need to have ventilators, okay? So that's the questions that are more interesting, that people have categorical imperatives. Many people do. And the problem with all this instrumental logic we see so far, which is most of the literature, is actually preventing people from thinking about these categorical imperatives and implementing these categorical imperatives. Okay, now, the problem with, if you have these sorts of solutions for a company and you say, well, this company would be losing money if they build ventilators, but they should do it anyway, is that technically it's the owners of the companies, which, whether you like it or not, are the shareholders that will be paying. It's a marginal claimant that pays the losses. So the shareholders would be the one paying for ventilators to save lives. And this has some legal issues. Like, these guys, may not agree with it. Like, why do you take their money in order to save some other people's lives? Like, who are you to just decide on this? So there is a big legal issue in the background here, which is that if a company is not running for profit, you will get into legal problems because the shareholders can sue you, saying, you stolen my money. But you can count on me to give you a solution. The solution will be unrealistic, of course, because otherwise everybody would have told you. The only way I could illustrate unrealistic, it was me on a bike trying to lead a pack of riders. That was my best illustration of what unrealistic looked like. So if you think about what is it people want, it's very rarely that they tell you, I want to do good because I want to do well. It's very rare that they tell you an instrumental logic. If you ask people what is it they want, they tell you they have a categorical imperative. They have an issue with not having a carbon tax. They have an issue with pollution. They have an issue with people not earning living wages. They have an issue with companies outsourcing things to countries where living and working conditions are very bad. They have issues with lots of things of that type. They don't have any issue with like, oh, I want companies to do good, more good, because then I will be even richer. Like, that's not what they say. So people are always talking about categorical imperative. And if so, this is what we need to think about. How do you implement a categorical imperative given the constraint I just gave, which is that if you simply tell the companies, here are categorical imperatives, take the money from the shareholders to pay whatever is needed to obey the categorical imperatives, you'll be under legal problems. If Apple say, I'm not going to build phones anymore at the lowest cost possible, then they may be sued by shareholders because they haven't maximized profits. The shareholders will lose money. And so how do you solve this? And by the way, Friedman himself, and that's this, what is involved here is often not quoted with Friedman, But Friedman mentioned the categorical imperative when he said his famous sentence that the purpose of business is to maximize returns, and he said subject to a categorical imperatives, and that always gets removed, but he did say that. So I see kind of like two ways to go towards that solution. One is the one that is currently most in vogue, and the other one that is like more where I lean, and I think I will try to push it, but it's very imperfect. But you know, let me know what you think. So some people say, well, let's force companies to disclose everything related to stakeholders. Let's force Apple to tell us everything about the working conditions in all the factories and so on and so forth. And then people can choose what they do. Okay. Then we don't violate any existing laws. People can just like put their money where they want. The companies just disclose stuff, and that's it. And there are even companies that says like, oh, let's like pay management for doing good things. Like you know, we pay management if they reduce carbon. Microsoft recently said, you know, we will pay management a bonus if they hire more women, for example. Okay, so like it's close to the old world basically, and just like having more disclosures, more financial incentives. And I called it common law because I feel it's closer to a common law approach of the world. Okay, now I would contrast it with the civil law, which is what I would try to defend here, which is basically that you state some rules, some fundamental rules that companies need to obey. So you say things like, you cannot have an employee not earning the living wage anywhere in the world. The companies that you hire to provide your input, etc. No one in the supply chain can earn less than the living wage. You cannot like use certain countries to avoid taxes. We're going to do it like what America does with individuals. We're just going to have a global tax rate for your global profits. And then if you pay less than that, technically because you have used other countries to help you doing that, then we take the delta. We put a carbon tax on, etc. In a sense, you just write the law that you would like. Okay, so it's like you have a dreamland, okay, and you say, okay, here are all the laws that should have happened. Government should have put them in place. The government should have had a Pigouvian tax on carbon and all these things. And I'm just going to write these laws, okay, which are not implemented by governments because they are useless. Okay, they compete and they are captured, etc. So I'm going to write all the laws that I believe in. That's my categorical imperative. These are all the things I think needs to be there. Okay. So you have written down the global rules of the game, okay, according to your beliefs, to your categorical imperative. And then what you do is that you say to companies, you elect to follow these rules or not. So you as a company, you say, I'm going to obey these rules. And so I, Apple, will not have anybody not earning the living wage. I, Apple, will pay a carbon tax. So whenever one of my guys will take a plane, etc., I will calculate my carbon footprint and I will pay a tax as a function of that. And I, Apple, will have X fraction of women on boards and on the executive teams and so on and so forth. I, Apple, will not have any wage discrepancies between men, women, minorities, etc. I, Apple, will obey all these principles. Okay. And that will give you then a stamp, and you will be a company that then have obeyed these rules, and the categorical imperatives have been implemented. And what that does then is that because then your shareholders know that these are the rules that you are obeying, then they cannot really sue you because ex ante you said these are the laws that I'm obeying. Okay, so I'm paying a carbon tax, I'm doing all these things, and that's what I will do. And then the shareholders are like, okay, then you didn't steal from me because you said ex ante that this was what you were going to do. Okay. So with the usual approach, I'm a bit afraid of like this death by paperwork. People want more disclosure. Like we see that, we hear that all the time. But disclosure kills disclosure. Like when you have thousands of pages to swallow, it's very costly and it kills the purpose. People just like drown the information. It's very costly. It's very, very difficult to get anything done. With this approach, I think it's ambitious. I think the transition to that world will be a bit tricky, but and we have all kinds of questions like who votes on the laws, who changes the laws, how do we avoid capture of the lawmakers, and so on. And maybe it's the United Nations that should implement this set of rules because they are the one who are behind a lot of these initiatives here. But the overarching idea is you create global rules and companies say, okay, I'm going to obey these global rules and my shareholders need to be in line with that. And it's going to be concessionary returns because I'm obeying these rules that are more strict than the normal rules. And I'm going to pay more taxes. I'm going to do this. I'm going to do that. So being more constrained, I'm going to have lower returns. And therefore, it's concessionary. And everybody knows ex ante, so I'm not violating the law and things gets done. Okay. So that's a bit the idea. So in a sense, you rely on like the citizens of the world. You have like a group of citizens that says, the world I want to live in will have these rules. And the companies will have to tell me whether they obey my categorical imperatives or not. And if they do, then I invest with them. I buy their products. And if they don't, I don't. Okay. So that's the overarching idea. So you avoid the problem of a lack of government coordination. You kind of kill the bullshit because, you know, people don't like greenwash here. It's like, these are the rules, these are the categorical imperatives. You just have to do it. Okay. You don't have to tell me, oh, I did this, but you know. So you have all kinds of companies that tell you, look, I'm very good. I'm a circular economy champion. But then, you know, you do your very best to avoid taxes wherever you can. And I'm not sure this is like really fair to people. And so here is like, here are the categorical imperatives. You have to obey them all. That's it, no discussion, it's done. There are things that are close to this that exist. The B Corp notion in the US is pretty close to this. But what I've just described is like B Corp to the power 100. It's like B Corp, to be a B Corp, you have this huge set of laws to obey. And we have in the European Union something called EU Eco label. That's also like, it's a label that you get when you are doing everything right on the environmental front, for example. So you could imagine something broader than that, even like that it's environmental, how you treat employees, etc., etc. And then you get the label only if you obey all these categorical imperatives. And if you are a fund and you want to call yourself an ESG fund, then you have to invest only in companies that have the eco label. Otherwise, you just, you know, then it's just BS. Okay. So Lucy 26,000 in France is another label like this. So that's a bit the idea, but this becomes the norm, but it will be very important to have a single one for visibility reasons, so that in every package of a company or in any company website, we know where the company sits with respect to a number of categorical imperatives that we all have in order to save the planet, basically. Okay. So I want you to take an example with like women on board. If you go the usual way, you say, please tell me how many women you have on board. Please disclose all the data about women or minorities, etc., in your company. If people try to put pressure on companies, they do some anecdotal studies saying, oh, look, this company had increased the number of women and then they make more money, so that must be good. You lobby, you pay management as a function of their women, like I said, with Microsoft. My approach is like, if you believe that it is a categorical imperative that there is more than a certain fraction of women on board, you just put it in these global rules of the game. And any company that does not have that is not eligible for any green money, is not eligible for any green bond, is not eligible for ESG funds, etc. That's it. It's a categorical imperative. Right now, it's like some companies are doing some things that feel nice, some things that don't feel so nice. So everybody gets some different ratings as a function of how people feel about like the good things and bad things they do. Here it's more like, these are the categorical imperatives. You need to do this, period. Of course, there can be some flexibility. One may say, you know, maybe it's not that categorical, that we have a certain fraction of women on boards or minorities. And so we could just like give the number of stars, the function of how well the company does on this towards our categorical imperatives. You can have some flexibility, but the idea is more that you need something that bites. You need something that says, here are the rules, these are the laws, these are the principles that you need to obey to get the label or the title. And then, again, you kill the greenwashing, because the guy who comes and say, oh, look, I've done this paint, and then this paint now is more environmental friendly, so I'm a good guy. And you're like, well, how did you treat employees? What was the salary of management here? What was, did you respect all the norms and so on? And if you did, that's fine. But did you obey all of our categorical imperatives? In a sense, a bit, again, like imagine, people say, I've created jobs and I've done this and I've done that. So I'm a good guy. So I should have a high ESG ratings. And you're like, yeah, but you took your private jet to go to Davos and you need to pay for this carbon footprint. Right now, planes actually are subsidized compared to cars because they don't pay taxes on gas consumption. And the reason they don't pay taxes on their kerosene consumption is because there's competitions between countries. That's a perfect example of a failure of a current system. Here, the system would say global rules of the game. Anybody taking a plane pays a tax. So in your company, you calculate all your plane trips, you calculate your carbon footprint, and you're going to pay a tax as a function of that. And the tax can be zero overall, and we give some money to the guys who have been good, and we take money from the guys who have been bad. But the principle is this, is that countries are competing, they don't manage to implement a Pigouvian tax. So citizens say, I'm going to create my own world, and companies would have to tell me whether they obey or not. And only if they obey, then they qualify for ESG money, green money. All this money wants to do good and to have a real impact. So I think that we need to acknowledge that the usual tools do not work. I think most people have come to this realization. And we need to stop selling ESG for what it is not, like a sure source of performance and this instrumental logic. It's very dangerous. There are two separate concepts. One is, it's another set among many sets of business tools to improve performance in some companies and not in others. Okay, that's just fact. And most importantly, it is a long-term moral obligation. It's a categorical imperative that people are articulating. Okay, and if we work from that basis, it will be much more productive, much less confusing for people. There will be much less debate. We can go towards a solution in much faster. So if you want to have a purpose, just maybe adopt rigor as a purpose. And even when, like something like high ESG stocks did better during the COVID and that helps your message, then stay away from this because that's not a rigorous way to prove your point. And so stay with rigor, okay? And you have a crowding out effect. If you get the same points, if you buy a green bond that they call a BS green bond, meaning one that pretends to be green, but there's no additionality to it, and it's still called green bond because it's dressed as such. If you get the same as if you invest in a real green bond that has an impact that is additional, then the thing with a real impact is not going to get much traction. People are going to go to the BS one because the BS one promises normal returns. And so you are hurting your message by not accepting or by not recognizing or thinking about the fact that you need additionality. If you need additionality, it's concessionary, and if it's concessionary, you need to face the fact that it is often illegal, and therefore you need another set of rules that companies ex ante needs to say, I'm obeying to, I'm giving concessionary returns, etc. And my shareholders need to agree to that ex ante, like in a B Corp in a sense. Interesting work for us as well. So try to separate, to find separating equilibriums between the BS people and the sincere people when it comes to green stuff. We need to know how to disentangle. Now, my first intuition, but it's just a rough first intuition, is that probably the way people are paid would enable me to separate who's sincere about building a better world and who is doing it for an instrumental reason. So the difference between somebody who's categorical and say, I want to do a better world for the sake of it, and somebody who says, I want to build a better world, but it's kind of cool that I have this instrumental way to justify my pay. Maybe, the pay structure can help us disentangle. And of course, by all means, any companies that does something great, to help the planet, somebody finding a solution to make paint more environmental friendly, BlaBlaCar, who I love and I use all the time, that enables to reduce the number of cars on the road by facilitating car sharing. I do that all the time, even though it's a negative NPV project for me. I take people in my car whenever I drive using BlaBlaCar. These companies are fantastic, but they are run for profit. So they're normal companies. They don't need a special capital to go and finance them. They are normal companies. If they want to be run for charity, like for no profit, then fine, then they have charity status for them. They can do that and raise money and then just run as charities. It's good too. So I'm not saying that, you know, like we shouldn't encourage like nice companies, but we should be very careful about how we sell them to the ESG green money. People wants to have an impact. Okay. So because I'd like to engage in Q&A and hearing a bit more what people's reactions are, I propose to stop here and listen to the questions.
Thanks a lot, Ludo. So there are some different questions on additionality. So maybe we can start by this question. So one attendee asked about how do you potentially measure it?
Yes, so that's often, people often say, you know, like measuring impact, and it's like the golden question, right? We don't know how to measure impact, and so it goes on and on. For additionality, it's a bit the same. My intuition would be the following one. Imagine that we're going to take the example of BlaBlaCar. Okay, imagine that you were there at the beginning of BlaBlaCar. Your idea was, I'm going to create a car sharing app so that whenever somebody is moving from point A to B and they have seats left in their car, this is the principle of BlaBlaCar, they put the number of seats they have and where they go and at what time. And anybody can see that and then join them in the car, and they pay, you know, very low amount of money, and then they basically each hike in a safe way. And so this is the principle of BlaBlaCar. So imagine you are raising money for this idea, right? That's your startup company. You go to the market and then you say, look, that's a business plan. I want to do a car sharing company. I think I can get market shares against trains. I can get market shares against some public transport. I think I can be, you know, if I just take €1 each trip, I will get this much sales a year. My app doesn't cost too much. I think I can generate this much profit. This is my business plan. If you find money normal money to invest with you, you have no additionality. Like you raise your money, people just invested with you, venture capitalists, people who are profit seeking, gave you money because they believed in your business plan. That's it. There was no additionality. You're good. Okay. Now, what if you're trying to raise money and you fail? Because people say, you're not charging enough. It's good that you do this public service and you reduce pollution, but you will never make money with this. Okay. You will not make money with this idea. And so you don't find financing. Then you have to turn to another type of capital and say, look, I have here something that can reduce pollution and the like. It's a good idea, but it will not make money like other companies. And therefore, you need to, I'm looking for concessionary returns. I'm looking for people who accept this deal. That money by construction will be concessionary. So the definition for concessionary for me would be when you went to the normal route to finance a project and nobody wanted to back it up, then you had to turn to another source of capital where you had to say, look, I know it's not much money that we'll be making with this business, but it's a nice business, it's a good business, it's good for humanity. And then you have this other type of money that comes to you, then this was concessionary. Then you have additionality. Because without this nice money, you wouldn't have managed to do this project. So this project wouldn't have happened without the nice money. So that's the definition to me of additionality. So it's a bit like when you have like DFIs, like IFC and the others, when they would go to a project, they would say, can you not do this by yourself? Can you not raise money for this hotel by yourself? And if people can really demonstrate like, no, I really can't. And then you think it's like a good thing to do for the country, then you say, okay, I'm going to do it. But by construction, if other people have refused, it means that you are accepting concessionary returns. You're doing something other people don't want to do. So you are accepting a risk-return trade-off that others haven't accepted. You are into concessionary space and additionality. So that would be, to me, the test to disentangle.
There are still a few questions on additionality. To make it more interactive, because I have two very long questions on this topic, I propose to unmute Algert. Algert, would you like to ask your question by yourself on additionality? So you can, yeah.
Can you hear me?
Yep.
Yeah, no, I was just asking one simple thing. That what you are saying is true, but then companies do not verify the feasibility or the extra profit of their green projects until they go to the market, right? So somehow a company that takes the initiative of doing a green project kind of faces the adversity of this project without knowing the returns, right? So somehow I see that if they make extra money at the end of this project, they only made it because they took extra risk that was not by definition remunerated at the beginning.
Yeah, and then what would be the consequence on the takeaway?
So I see the additionality in a green project when it starts. When it starts, it's not given that it will have extra returns. So at the beginning, it might very well fail because a green project on average has extra costs, has additional costs. So these people that engage in green project, they engage in extra costs. So whatever they get extra compared to their competitors, I think, or well, I'm not an expert on additionality, but I think it is additionality in this case.
So I'm not sure. I mean, I would go back to the definition I just gave. Like, if no one wants to finance this project ex ante, and somebody comes and finances it, then this is additional, because it wouldn't have happened without special nice money that accepts this risk-return trade-off. Ex post, you may have a project that was additional that turns out to do extremely well, just like you would have some that do extremely badly. But that's the ex post outcome. That can just be anything. But ex ante, that would be like the definition. Like, no one else would finance this, and so you need nice money. And so again, you have all this money in the world who wants to do well, and right now they are directed to like ESG funds or things like that that are not really having any impact as far as I can tell, without like making a number of assumptions. If instead you would explain to people, you know, you want to make a difference, it needs to be additional. Therefore, we're going to finance only things that wouldn't have been financed otherwise. And this is where your money is going to go. And so it's going to be mainly private markets. That's why the initial title of my talk was like that. Then you can say to people, it's going to be concessionary, it's going to be additional. And then you're truth telling. It's all coherent, at least as far as I can tell.
Okay, one last question on additionality from Orkun. I can also unmute him too if I'm not clear and if you want to elaborate on it. But your assumption when you define additionality is that there are perfect market conditions and no asymmetric information. So what do you think about the importance of voice versus exit from the investor?
I don't know. Yeah, this may have some impact, but we don't have much proof of that. It's a bit hard to, you know, we don't know the degree of inefficiency of the markets. You need quite a lot of assumptions for like the markets to be inefficient, and somehow a subset of the people have the light, they see it, and no one else does, and there is no arbitrage. And so it feels very unintuitive that like by spotting high ESG things, you would get higher returns, or like it's very hard to like understand how that would work. I spotted a question by Sarah, but I like a lot. I think that I've put it somewhere on my slides. They were very long. There was lots of text, but I like a lot what Sarah says here by pointing out that you have mutual fund managers that say, "Oh, I'm doing like an ESG mutual fund," but themselves in their team may have like no women, no minority. They may get like very high salary for like pretty poor performance. They may themselves take a flight every 5 seconds to go to see a client, and so on and so forth. So it's a bit the syndrome of people taking a private jet to Davos to tell the world to better behave because otherwise the planet will go away. So in my world, and of like when you're a mutual fund manager and you want to say, you know, I'm going to be green, I'm like nice money, then not only you need to invest in companies that obey these global rules of the game, but also yourself need to obey the global rules of the game. So you cannot hire, you know, cleaners of your office that would be below living wage, and so on and so forth. Like you clean, like yourself, your company, what you invest in, etc.
There are a lot of questions on your civil law versus common law comments. So the first one is, how realistic is it that countries will agree on common rules?
Yeah, so the beauty of that would be that they don't need to agree, right? Like you bypass the countries. You say, these are the rules that we are going to obey. Like a number of citizens are just saying, you know, that's what we want as a world. And even if the countries disagree, then, you know, if the companies just accept to pay a tax as a function of how much carbon they issue, if they accept to have a certain fraction of women, if they accept like all these categorical imperatives that we have, I'm not saying that these are the right ones, but these were examples, then you don't need the governments to agree. You only need the governments to agree that this wouldn't be illegal for a company to obey that set of rules. So you do have a bit of a legal issue, like B Corp in the US have to be approved by different states. And so you still need to make sure you don't violate the rules of a country. But the idea would be that because the rules you obey as a company are more strict than the rules of the countries in which you operate, it should be okay. Like nothing prevents you as a company to pay people a living wage. It doesn't prevent you to take less planes, to pay a tax to someone, to give like a donation if you take the plane too much and things like that. So it should be okay legally. The beauty is you don't need a coordination between countries. It's like it's citizens who say that's what we believe in, and we want to invest only in companies that obey these principles, and we will buy products only of companies that obey these principles.
And with regard to civil law, don't you think that the problem is that what we believe to be right imperatives continuously change over time?
Yeah, so that's a good one. So that was one of the question mark I had a bit earlier. We could think of it would be a citizen movement, right? It would be citizens saying, you know, this is what we believe our imperatives are. But of course, as technology develops, you may, you know, not accept something that you were accepting 10 years ago, or you may get new evidence that tells you, well, there was this thing you didn't know about, but that's not acceptable. Yeah, you will need to have like, somehow you're recreating a country, you're recreating a parliament, you're recreating a set of laws. These laws need to evolve, people need to vote on them. And so you need to think about what that would look like a government that is not following frontiers, but it's like 1/3 of the planet says, we want to work with these new rules because we think that this is the only way to save the planet. And so we don't wait for governments to coordinate. We don't wait for all of that. We just decide that these are our rules. And you need to find a democratic way to get indeed dynamic rules. And so a parliament, maybe a tribunal to judge whether a company has violated the rule or not, and therefore needs to be excluded from the label or not, etc. So these are like interesting questions that would then have to be developed.
Okay, I think you partially answer another question on who will be monitoring and enforcing the law. So
yeah, so I thought about the UN because the UN is the one that took a number of initiatives, and it's kind of like a group of countries. But the countries wouldn't need to be involved. It could be the UN saying, you know, I'm gonna have a global vote to have like a representative set of people that monitor this, or but yeah, it raised an interesting question about the democracy and how not to be hijacked, because you could have like, you know, some people who want to burn forests in Brazil and the like getting in and trying to vote, you know, against what you want and things like that. So it's not easy to solve the democratic aspect of it. But I think it's an interesting challenge where you realize that in this world, frontiers are kind of like, you know, they don't exist. We are all here on the same call, irrespective of where we are based. And so why wouldn't be able to write like rules under which we want to operate, to buy things and to invest in things. And so, but but I think it's an interesting thing to think about. Again, I'm raising a lot more questions than I'm answering, but it's just a thought I'm having, and I wanted to share with you.
I'm going to unmute Robin Dotling because I think it would be worth that he explain his question. So we are moving on the side on the ESG performance, and he said that he does not totally agree with your view that the literature is only limited to be doing well by doing good. So I will allow him to unmute.
Thank you. Hi. Yeah.
Okay.
No, I just. At some point, you said that also the academic literature seems to be only looking at ESG as something that improves performance. So this idea of doing well by doing good. I just thought, I think the literature does acknowledge that, at least the theoretical literature for sure, that you should have lower returns on if you're investing in something out of a social purpose, for example. And I think there's also a lot of people would agree that the recent good, strong performance is probably because more people have become aware. So it's indeed more a short-term phenomenon where preferences have shifted towards ESG, and then this has driven performance in the short run. But in the long run, you should expect.
So I'm comfortable with that, but then we need to tell people that, right? You could say, over the last 10 years, high-rated ESG things had higher returns because people realized this, and now they have, and so therefore going forward, you should not expect the same outperformance. I agree that there are some people, putting that in their models, but it's pretty hard to do the opposite in a model, and they tend to be economists, though. People who are not economists have a very hard time, accepting the non-win-win paradigm, in my experience, like in what I read. And
right. Okay. Thanks.
But economists, they find natural. Yeah.
Thank you.
Okay. I have my colleague George Hübner, who is proposing as a solution to go for a communist system. So I think I will also unmute him. So where is George? Let me check. I see him here. Yes. George, the floor is yours. Is it working? You need to unmute. So I authorize you to unmute it, but you have to unmute it.
Okay. Can you hear me? Yes?
Yep.
Okay, if you go to the end of your logic, you're going to create an awful body of law which is going to be enforced by everyone. And of course, since we live in a capitalist but also in a liberal system, there's going to be a lot of free ride for those who benefit from a lot of asymmetry of information. So if you want to avoid this free ride, and if you want to have a common rule that is adopted by everyone, so a level playing field, you probably need to have a much more different system than the democracy. And does it go along with a communist system simply? My question is over.
I think we have a problem with Ludo, who is now disconnected. Thanks for your question, George.
Thank you. You're welcome.
He just decided to escape.
Yeah, probably my question was disturbing.
So he will probably be back.
I wanted to be more provocative than he was. So.
Yeah, I see that. Okay, sorry. So his internet is completely down, so he will join us by his phone, but maybe someone has an answer for George. I see Alvin who's raising his hand. Do you have any proposition? I will allow you to talk. If you want to, you can do it. Alvin, you wanted to ask something?
I'm here, but sorry about that.
Okay, So Ludo, you were afraid of the question of George Hübner, right?
Yeah, I got completely scared. Like he said that communism and totalitarianism. So what was the question again? Everything went blank when it started. So yeah.
Shall I repeat the end, perhaps?
Yeah. Thank you.
So if you go to the end of the logic, and if you want to avoid any free ride and to enforce a level playing field, you need to enforce it in a way that nobody could escape it. So actually, democracy doesn't seem to be the right tool in order to enforce that. And it looks to me that the right system would be a communist system.
Yeah, so the free riding is you're very right. I mean, the free riding is a big deal. I guess my underlying assumption, and if we look at the huge amount of money going into like that is there, but people say, you know, I want this money not to profit at the expense of others. I'm okay with having lower return than the max achievable. Then it looks like it's quite a lot of money that could be that would be available, and that it is not necessarily that it is not just that people are not afraid of free riding. So I agree that like if everybody is like purely homo economicus, they would say, you know, why would I accept lower returns to save the planet if others do not? Why would I buy organic food to help the planet if others are not? But what we do see, it seems that people are not behaving like homo economicus. Lots of people, like me included, I'm happy to follow lower returns with lower returns if they don't hurt people. I'm happy with buying organic food. I'm happy with, even if like, of course it's for my health, but also because I believe it's the right thing. I take people with blah, blah car, even though it makes no economic sense for me per se, but I think it's the right thing to do. And I think there are lots of people that want to do the right thing. And so we wouldn't have as strong as a free riding problem as what we may fear. If we have a big free riding problem, then I think we are toast. I think there is no solution.
Okay, maybe one last question for the end. I would like to ask the question of Pierre Chéniaud about the life cycle for firms. So do you think that there will be some differences between startups and large firms, and how would it go with regard to the renegotiation with an existing shareholder base when it takes place?
Yeah, I mean, the transition is tricky, but I'm happy with acknowledging somebody who already has a shareholder base, and then you have to explain to the shareholders that you're going to switch status. In a sense, the B Corp experiment is interesting, with like a company like as big as Danone going to their shareholders and saying, I'm gonna change the rules I'm obeying. They're not too dramatic, the ones of B Corp, but they are quite constraining. So where it would be a bit problematic if companies that are switching then lose a lot in value. But again, if there is that much money that wants to do well and to do good, so not well, but good, the money wants to do good, it is not necessary that the value of a company would decrease. And so maybe we might be able to match current shareholders with the new shareholders at the current price. And then the new shareholders say, it's fine, from this point on, we accept this new behavior. The older shareholders move out, not at a loss. So there is a lot of elements in what I've said, but that are not worked out, of course. But that would be the idea. For new companies, it's trivial indeed. If you start and then your shareholders are people who want to do good, then it's a lot easier. For existing firms, more complicated.
I think we still have time for one or two questions. There was also an interesting one with regard to, is there any fear that finally companies that do not follow the principle will still be able to outcompete good companies? So what do you think about that?
Yeah, I think intuitively there will be room for both. It's a bit like you would have some companies saying, look, I cannot afford to pay these extra taxes, or and so on and so forth. And they would be under the old regime, and you have the new companies that would be more constrained. I think the only difference would be that the companies that obey the principles would have potentially lower concessionary returns. But they can still both coexist, I would think. It's a bit like, if you take like Apple and the iPhone, it's a 90% margin. If a company like Apple would say tomorrow, I'm going to pay everybody the living wage, etc., the price of the iPhone, doesn't even to move, their margin would simply shrink from like 90% to 70% or not even. And so I think you can still have like competition and things like that. Again, we see a lot of companies with labels and like now, like the Eco label in Europe, the B Corp and so on. I mean, they continue competing against others. It's not as extreme as what I was proposing, but it's pretty close. So Danone is switching to B Corp. Danone still compete with the other companies.
Okay, one question from Romulo. Some people have proposed giving more voice to all the stakeholders. For instance, having employees on the board. So what are your thoughts about this?
Yeah, it's a solution, but I don't know if it's not easy to have everybody around the table, right? I mean, like for employees, yeah, maybe it's better to have employees that have a vote on the board, but the problem also is again this competition between countries. So imagine that you don't want your employees to be on the board, and that's the rules that Ireland is putting in place. Then you move your company to Scotland, and then you won't have that rule. So companies can go anywhere they want. If they don't like a rule, they go somewhere else. The advantage of this system is that you would say, imagine that you would have that as a categorical imperative, but we would agree that you need to have employees representation on boards and things like that. Then you could say that's one of the rules for one of the to get this label. And then in that case, you don't have to worry about the company going from one country to the other. It's just like, if you want the label, that's the rule. If you want to be called nice or green, then you need to give a voice to your customers or employees, etc. on the board. We believe that's the best thing. So that, if anything, that system to have this centralized or more centralized label-based or principle-based system would facilitate things like having more representations on boards from different parties.
Thank you very much. We are perfectly on time. Thank you a lot, Ludo, for the very insightful discussion we had tonight. Thanks to all participants for making this Corporate Finance Day possible. I think we had very interesting discussion. Let me also announce that next year the Corporate Finance Day will be organized by Thomas Lambert, who is right now with us in Rotterdam, so Erasmus University. So I thank you all. Thank you, Lupe, to help me with this setting of the keynote session, and see you soon.
Thank you.
Thank you.